The real formula for consistent profits in trading. Everyone talks about getting rich quick in the stock market. But let me let you in on a secret. The people who actually make money in trading, they do the boring stuff really well, and they do it every single day. The formula for being profitable isn't a mystery. It's just ignored because it doesn't sound sexy. Step 1. Trade with an edge. This means knowing exactly why you're entering a trade. Are you playing a breakout, a reversal, a retest of a moving average? If you can't answer that in one sentence, you're gambling, not trading. Step 2. Risk management is your lifeline. This is where 95% of people blow up. They take one trade and risk 50% of their account, praying for a home run. Meanwhile, pros risk 1% to 2% max and live to trade another day. You want to win long-term? Control your losses. Period. Step 3. Stay consistent with your strategy. Jumping from MACD to RSI to VWAP to moon phases, that's called being confused, not being a trader. Pick a strategy, master it, build confidence, then scale. And finally, journal everything. If you're not writing down your trades, entries, exits, emotions, setups, you're not growing, you're just guessing. Your trading journal is where you meet the real version of yourself as a trader. That's where the money is. This isn't Vegas. You're not here to spin a wheel. You're here to stack probabilities, manage risk, and execute with precision. Do that, you'll be profitable. And more importantly, you'll be consistent. Coming up next, the difference between a losing streak and a learning curve, and how to survive both without blowing up your account or your ego.
The difference between a losing streak and a learning curve. Let's get one thing straight. Losing is part of trading. If you think you're going to win every trade, you're either new or delusional, or both. But here's the key. A losing streak doesn't mean you're a bad trader. It might just mean you're in the middle of a learning curve. Every strategy has drawdowns. Every setup has false signals. The pros? They don't panic. They expect losing streaks and have rules in place for them, like reducing position size, sitting out during chop, or doing a full post-trade analysis before even touching the next setup. The amateurs? They revenge trade. They chase. They switch strategies faster than their internet tabs. And then they blow up and blame the market. That's not a losing streak. That's self-sabotage with a brokerage account. If your trades are failing because you're sticking to your edge and it's just not playing out right now, that's a learning curve. Document it, adjust if needed, but don't throw everything out. You're collecting data. You're sharpening judgment. You're becoming dangerous, in a good way. So next time you're down 3 or 4 trades, stop crying about it and start analyzing it. Fix the leaks, not the whole ship. Next up, why most traders quit too early and how to become one of the few who don't.
Why most traders quit too early and how to become one of the few who don't. Let's be real. Most traders quit before they even start getting good. Why? Because they want microwave results in a slow-cook game. They see someone flash a $5 K profit on Instagram and think, I can do that by Friday. Then they blow up a $500 account and delete Thinkorswim like it's haunted. Here's the truth. Trading mastery doesn't come in months. It comes in iterations. You don't learn trading, you become a trader. That means building the mental discipline, emotional control, and system refinement that only comes from getting kicked in the face by the market and standing back up smarter. Most people quit the moment it stops being fun. The winners. They study their losses like crime scenes. They collect screen time like it's rent. And they stop looking for magic indicators or secret chat rooms. They build skill. You want to be profitable? Then stop quitting every time it gets hard. The market is designed to shake you out. Your job is to shake back smarter. Next up, how to make peace with boredom, because that's where real money lives.
The market doesn't owe you profits. Let's wrap with this. The stock market doesn't owe you a dime. It doesn't care about your dreams, your rent, or your gut feeling. It rewards discipline, patience, and execution. So the sooner you stop trading for excitement and start trading for consistency, the faster you'll stop bleeding and start building. Now go sharpen your edge.
How losing trades make you a better trader. Nobody likes losing money, but let me tell you something that'll make half of you roll your eyes and the other half finally start making money. Losing is part of the damn job. Every pro trader, yes, the ones you obsess over on YouTube with Lamborghini thumbnails, they've all taken gut punch losses. What separates them from the blown-up accounts isn't magic, it's what they learned from those losses. Losses are data. They tell you what setups suck, what timeframes expose you, what emotions wreck your entries, and where your system has holes big enough to sink a cruise ship. And guess what? If you ignore them, you're doomed to repeat them until your broker account politely asks you to leave. Here's how to make those losing trades worth something. Ramifications. Emotion, entry, exit, why you took it, and what was happening around the market. Reply your indicators. Did you even follow them? Did RSI scream overbought while you yelled YOLO? Timelines down after losing streaks. You're not a hero, you're hemorrhaging. Fascination. Your trade again with a better setup. Learn what should have happened. The real flex isn't winning trades. It's surviving losses and coming back smarter. Transition to next script. Now that we've unpacked the brutal beauty of losing, let's talk about how risk management is the real moneymaker, not your hot takes on Twitter. Ready? Let's go!
Build a strategy so good you can trade it in your sleep, but don't. So your psychology is bulletproof now, right? You've tamed the emotional beast. Great. But here's the harsh truth. Discipline without direction is just wasted energy. You need a system. A real one. Let's kill a myth real quick. No, you don't need 27 indicators and an astrology chart to trade well. You need a repeatable edge. Start with this. 1. Market condition. Are we trending or chopping? Your strategy should only work in one. If it works in both, you're either lying or a genius, and probably still lying. 2. Entry criteria. Define it, down to the candle. Don't just say, it looked good. That's what rookies say right before they blow up their accounts. 3. Indicators. Use no more than 2 to 3, preferably one for trend confirmation, like the 20 EMA or super trend, one for momentum, like RSI or MACD, and one for volatility, like Bollinger Bands. That's it. Don't clutter your chart. This isn't a Christmas tree. 4. Stop loss and target. Know your exit before you enter. If you're making it up on the fly, you're gambling, not trading. 5. Risk to reward ratio, 1 to 2 minimum. If you're risking $100, aim to make $200. Anything less, and you're just working overtime for Wall Street. Backtest that system. Forward test it, break it, then fix it. You want muscle memory, not guesswork. Because when the market gets violent, only the traders with a real system survive. Everyone else? They're just expensive lessons waiting to happen.
You don't just trade, you track. So you've got the setup, you've executed like a sniper, but now what? You close the trade and go celebrate? No, you go write it down, nerd. Welcome to the part nobody wants to do, but every profitable trader swears by: trade journaling. Let's break it down. Every trade you take is data. It's not just a win or a loss, it's a lesson in disguise. Start by tracking the ticker, entry and exit points, time of day, setup used, indicators involved, news or catalysts, your emotional state. Yes, that matters too. You're not doing this to impress anyone. You're doing it because patterns emerge. You might realize all your profitable trades happen between 9:45 and 10:30, or that every time you trade on a Friday afternoon, you tank your P&L. And here's the kicker. Journaling removes delusion. You might think you're a breakout trader, but your journal might prove you crush it more on reversals. That's how you find your real trading identity. Want to go pro? Add screenshots of your entries and exits. Record voice notes. Track how your indicators behaved. Get forensic with it, because while others are throwing darts, you're building a blueprint.
The market pays the prepared. You don't need 100 trades a week. You need a plan, discipline, and a journal that doesn't lie. The market doesn't reward noise, it rewards precision. So stay sharp, stay patient, and stop chasing, start tracking.
Risk management, the unsexy secret behind every profitable trader. You want to know the difference between a gambler and a trader? A gambler bets big and hopes. A trader risks small and plans. That's the game. If you're out here throwing your whole account at one play because this one's different, you're not trading, you're emotionally investing in a fantasy. And Wall Street loves dreamers because they're easy to rob. Here's the truth no one likes to admit. Risk management is boring until it saves your entire account. Most traders don't blow up because they're wrong. They blow up because they bet too much when they were wrong. One bad trade doesn't hurt. One oversized bad trade? That's the funeral. So what do? Easy. Risk 1% or less of your account on every trade. That means if you've got 10K, don't lose more than $100 if it goes south. Use stop losses like an adult. Don't average down unless that's part of your plan, not a panic response. Position sizing, stop placement, reward to risk ratios. These are the tools that separate the professional from the hopeful. And no, this doesn't make your trading less exciting. It makes it sustainable. You want thrills? Go to Vegas. You want consistent equity growth? Protect your capital like it's your last breath. Because in this market, it very well might be. Coming up next, we're going to break down trading psychology, because no indicator in the world can save a trader with a broken mindset. Let's get surgical.
Trading psychology. Your brain is your worst broker. So let's get brutally honest. Your brain is out here sabotaging your trades like it's getting paid to do it. You're not losing because your strategy sucks. You're losing because your psychology is as stable as a penny stock on earnings day. You take one loss, and suddenly you're rage-clicking buttons like the chart personally insulted your family. You win once, and now you think you're the second coming of Warren Buffett with a Red Bull addiction. This is exactly how the market wants you to behave. Emotional, impulsive, overconfident, and broke. Here's the truth. Every profitable trader is a master of their own mind. They've trained themselves to follow rules, not feelings. They've felt the FOMO. They've chased breakouts. They've revenge traded. And they've been humbled so many times that eventually the ego shuts up and the process takes over. You need to treat trading like a military operation. There is no room for vibes. You execute your plan, you accept your losses, and you walk away from the screen when your emotions start screaming louder than your stop loss. Journal your trades. Grade your decisions. Talk to yourself out loud if you have to. Yes, like a crazy person. Better to sound crazy than trade like it. Next up, let's finally talk about how to build a system. Because winging it only works if you're a bird. Stay locked.
Building your system. Stop winging it, you're not a seagull. So here we are. You've blown a few accounts, blamed the market, screamed at your indicators, and maybe even punched a monitor. Now you're ready to do what you should have done on day one. Build a system. First rule, if your system can't be written on paper, it doesn't exist. Winging it is for seagulls and gamblers. Real traders operate on repeatable criteria: entry, exit, stop loss, risk management, and trade review. Every time. No exceptions, no feelings. Pick your indicators, but not all of them. You don't need RSI, MACD, Fibonacci, stochastic, Bollinger Bands, Ichimoku clouds, and your grandma's moon cycle tracker. Stick to 2 or 3 tools that align with your style. That's it. Master those like a sniper masters his scope. Then backtest. No, not in your head.
Actually go through 100 plus charts and ask yourself, would I have taken this trade? Would I have survived it? If your system can't survive 2020 volatility and 2022 chop, it's not a system, it's a fantasy. Finally, test in real time with small size. Not because you're scared, but because you're smart. pilot mode before beast mode. Up next, let's break down risk like it owes you money, because it kinda does. Risk management, the part you ignore until you cry in the shower. Ah yes, risk management, the broccoli of trading. Everyone knows it's good for you, but most of you treat it like a suggestion, instead of the one thing standing between you and financial ruin. Let's get something straight. If you don't control risk, the market will do it for you. And spoiler alert, it has zero chill. You want to risk 20% of your account on a single trade because you feel good about it? Congrats! You're officially a degenerate with a Robinhood account in a dream. Real traders risk 1 to 2%, max. That's right, max. If you have a $10,000 account, risking $100 to $200 per trade gives you 50 to 100 trades before you get wiped. Risk 10%? You get 10 tries before it's lights out. Hope you're lucky, you'll need it. Now let's talk stop losses. They're not a sign of weakness. They're a sign you've evolved beyond caveman trading. Every single trade needs one. No exceptions, none. And no, mental stops don't count. That's code for, I'll sell when it hurts too much, which means you're already too late. Size your position according to your stop. If your stop is 50 cents and you're risking $100, you can buy 200 shares. Not 500, not 1,000. Do the math, or go back to paper trading. Coming up next, reward, the fun side of risk. Let's talk about how to actually stay green.
Reward to risk ratio, why most traders are glorified gamblers. Okay, now that we've dragged your risk management habits through the mud, and rightfully so, let's talk about reward, because yes, there is a light at the end of the tunnel that isn't just an oncoming train. Here's the rule, never take a trade unless your potential reward is at least twice your risk. That's called a 2-to-1 reward to risk ratio, and if you're risking $100, your goal should be to make $200. If you're risking $500 to make $100, you're not a trader. You're a hopeful romantic with a gambling addiction. But what if the setup looks really good? Cool story, bro. Hope that pays the bills. High conviction doesn't replace math. In fact, the more emotionally attached you are to a trade, the more likely it is to slap you in the face like a rejected ex. Here's what smart traders do. They let math do the talking. If your stop loss is 50 cents away, your target better be $1 away, or more. Otherwise, you're taking trades that require you to be right way too often. And unless you're psychic, you're not. That's not sustainable. You want edge? You want profit? Start with a system that wins 50% of the time but pays 2x when you win. You'll be profitable. Not rich overnight, but consistent. And consistency, my friend, is how real traders make money and sleep at night. Next up, let's talk about the setups, because a good setup is what gives reward to risk its teeth.
The setup is only as good as the execution. You've got the perfect setup. Trendline bounce, support holding like a Navy SEAL under pressure, volume kicking up, RSI sitting pretty at 45. You even whispered sweet nothings to your chart before entry, but somehow you still lost. Why? Because your execution was garbage. Let's make this crystal clear. The setup does not make you profitable. The execution does. You can have the Mona Lisa of technical setups, but if you hesitate, chase, or enter without a plan, you might as well light your cash on fire and post it on TikTok for likes. Execution means knowing exactly where you're getting in, where you're getting out, and what you're risking. If you're entering on emotion, or worse, because someone in your Telegram group said, "Yo, this finna moon," you're trading like a child playing dress-up as a trader. Smart execution is surgical. It's pre-planned. It's boring. It's calculated. It's what separates professionals from YouTube wannabes. You want to hit consistent green days? Then you need to execute your setups like a sniper, not a spray and pray infantryman. You wait, you time, you pull the trigger only when your target is in sight, and then you manage that trade like your career depends on it, because it does. No more entering too early because you didn't want to miss the move. No more exiting too late because it might still go up. No more moving your stop because your feelings got involved. Listen up. The market doesn't care about your feelings. It respects discipline. And if you don't respect your own rules, the market will remind you, loudly, publicly, and with a red P&L. So next time you get a beautiful setup, don't treat it like a lottery ticket. Treat it like a mission. Plan it. Execute it. Get in, get out, get paid. And don't worry, we'll cover exactly how to build execution routines in the next video, so you stop improvising like a broke artist and start performing like a paid assassin.
How to spot a garbage trade before it wrecks you. Let's talk about trade selection, because, brace yourself, not every setup is worth your precious capital. Shocking, I know. But you wouldn't believe how many traders chase every green candle like it's a clearance sale at Best Buy. That's how accounts get torched. Here's the truth. Most trades you see during the day, absolute trash. They're pump fakes, bull traps, liquidity hunts, or momentum mirages. And if you're still falling for those, you're not a trader, you're the target. So how do you filter out the junk? Step 1. Context is king. Zoom out. Is the stock in an uptrend, a downtrend? Is the market overall bullish or bearish today? Are you trading with the tide or trying to surf during a tsunami? Step 2. Liquidity. If you're trading something that barely moves and has a 12-cent spread, you're just volunteering for financial waterboarding. Look for tight spreads, clean order flow, and real volume. If you see a 5-minute candle that looks like it sneezed and died, walk away. Step 3. Confluence matters. You want multiple indicators agreeing, not one MACD squiggling up while RSI's tapping out and prices bouncing around like a drunk squirrel. Look for clear structure, meaningful levels, and confirmation. Otherwise, it's just noise with hopes and dreams slapped on top. Here's a cheat code. If you're not excited and terrified to enter the trade, it's probably not real. Real trades are tense because they matter. You did the work, you waited, now you act. That's where your edge is. Stop chasing, start filtering. You'll take fewer trades, but they'll be cleaner, sharper, and far more profitable. You'll stop being the person who's almost green every week and start stacking real wins like a professional. Next up, we're going to break down how to build your A-plus setup watch list so you don't waste time staring at 47 charts hoping something moves.
The real secret to consistency. Want to know why most traders never make it? Because they're emotionally invested in every single trade. They treat a red candle like a personal attack. Newsflash, the market doesn't know you exist, and it doesn't care. Consistency isn't about catching every move. It's about having a process and sticking to it like your rent depends on it. Because, spoiler alert, one day it might. Discipline, dopamine. Routine, randomness. You want results? Trade like a machine, not a fanboy.
The illusion of control. Why most traders risk like clowns at a circus. Let's get real. Most traders think they're in control just because they moved their stop loss 12 times and finally hit break even. That's not control. That's denial in real time. Risk management isn't about adjusting to your emotions. It's about protecting your capital from your stupidity. And no, tightening your stop after entering the trade doesn't make you disciplined. It makes you indecisive. You didn't have a plan. You had a hope. And hope belongs in a Hallmark card, not on your trading screen. Want real control? Define your max risk before the market opens. 1% of your account per trade? Good. Less? Great. More? Well, I hope you enjoy roller coasters, because that's what you just signed up for. Here's what pros do. They set their stop based on structure, not feelings. They size their position based on that stop, not greed. And they review that trade like it's game tape, win or lose. Meanwhile, new traders will bet half their account on a random Reddit play and act surprised when it goes to zero. But the volume was high. Yeah, and so is your delusion. Look, If you want to last in this game, your risk needs to be boring, repeatable, and precise. Not gut feeling, not vibes, not I saw it trending on X. You're building a machine, not a mixtape.
Stop losses, not suggestions, not decorations, actual survival gear. Let's talk stop losses. Those magical little lines that traders draw and then immediately ignore like they're optional gym memberships. No, your stop loss is not a maybe. It's not a soft boundary. It's your seatbelt in a head-on collision with the market. You know what kills accounts faster than a flash crash? Ego. People set a stop, then say, well, it's just pulling back. And the next thing you know, they're 30% underwater, lighting candles and praying to Jerome Powell for a miracle. Listen, if your plan was to risk $100 and you're now down $450, you don't have a trading strategy, you have a gambling problem. Great traders don't hope their trades work. They define risk, preload stops, and walk away. That's called discipline, not disengagement. Want to level up? Use bracket orders. Automate the pain so you can't outsmart yourself. And no, wider stops do not equal smarter stops. They equal bigger losses, unless your sizing is adjusted like a grown-up. If you're setting a 5-point stop with the same size as a 1-point stop, congrats! You've just multiplied your risk by 5 and called it strategy. The stop loss isn't just where the trade is wrong, it's where you were wrong, and it's time to admit it. And that's okay. That's not weakness. That's survival. Set your stop, stick to it, and for the love of charts, never move it just because price action is making you nervous. You're a trader, not a toddler.
Position sizing, because all-in is not a strategy. Let me guess, you found the setup so beautiful, you threw your whole account at it? Bold move, Maverick. Unfortunately, this isn't Vegas, and that's not a roulette wheel. It's the stock market, where improper sizing turns good trades into financial trauma. Position sizing is how you survive long enough to get good. It's not about maximizing profit. It's about minimizing stupidity. You want to risk 1 to 2% of your account per trade tops. Not 10%. Not whatever feels right. Not this one looks different. No, math doesn't care about your feelings. Know your stop loss? Great. Use that to calculate your share size. If you're risking $50 and the stop is $1 away, you're taking 50 shares. Simple, elegant, professional. Oversize and you're emotional. Undersize and you're wasting setups. Nail your sizing. And suddenly, your trades stop feeling like death matches. Want to trade like a pro?
Why most traders quit, and how you avoid becoming a statistic. Here's the brutal truth. Most traders don't fail because of the market. They fail because of themselves. And no, it's not just bad luck. It's bad habits with a sprinkle of delusion. The first trap? Unrealistic expectations. You watched one YouTube video, saw a dude in a Lambo, and now you think you're going to double your account in a week. That's not trading. That's a fantasy, with margin calls. Next, no risk management. You're going all in like this is Vegas. Spoiler alert, even Vegas knows how to manage odds. If your position size can wreck your entire account, you're not a trader. You're just renting capital until the market evicts you. And finally, no process. You wake up, scan Twitter, and hop into trades based on vibes. No journal, no backtesting, no edge, just vibes. You might get lucky, once, but luck isn't scalable. Discipline is. Want to make it past year one? Treat this like a profession, not a side hustle. Build a system, stick to it, and remember, consistency beats hype.
Why hot tips are the coldest way to trade? You ever get that message? Bro, get in now. This one's about to explode? Yeah, that's how 95% of retail traders get wrecked. Hot tips are the stock market's version of chainmail. Someone sends it, you bite, and before you know it, you're the exit liquidity. Here's the thing. By the time you hear about a hot stock, the smart money already ate. The pump is done. You're walking into a trap with a smile, hoping your lottery ticket hits while everyone else is cashing out. It's not insider info. It's outsider bait. Real traders don't chase tips. They chase data, volume spikes, technical setups, institutional flow, fundamentals that actually, fund something. If someone's yelling, "This stock is the next Tesla," but can't tell you the revenue breakdown or debt load, run. Trade what you understand, not what you're told. Because the only thing hotter than a bad tip is the regret that follows.
The myth of safe stocks. Spoiler, they're not that safe. So you think buying Coca-Cola, Apple, or some dividend darling means you've got it made? Welcome to the biggest bedtime story on Wall Street. The myth of the safe stock. Safe? Until it isn't. Let's be clear. Yes, blue chip stocks have historically weathered storms better than some random biotech penny stock that trades like it's on bath salts. But that doesn't mean they're invincible. Newsflash! Meta dropped over 70% once. Dollar T used to be safe too, until it wasn't. What people forget is that even so-called safe stocks are still stocks. They're exposed to earnings, lawsuits, regulation, tech disruptions, global crises, and of course, the brilliant logic of emotional investors. If you want safety, don't look for tickers. Look for risk management, stop losses, position sizing, a game plan. Because nothing you buy is safe if you're reckless. So next time someone says, "Don't worry, it's a safe stock," ask them if they also believe in unicorns, or if their portfolio is insured by the Tooth Fairy.
The market doesn't care about your feelings. Let's get something straight. The stock market is not your therapist. It doesn't care that you felt like Apple was going to go up. It doesn't care that you had a good feeling about Tesla. And it definitely doesn't care that you maxed out your Robinhood account because some guy on Reddit said YOLO. The market isn't kind, cruel, or personal. It's math, psychology, and cold-blooded execution. It rewards discipline and punishes hope. If your strategy is based on vibes, good luck, because that's not trading. That's gambling with a prettier name. So before you click buy because your gut told you to, ask yourself, do I have data to back this up? Or am I just emotionally attached to being right? Spoiler, the market doesn't pay for being right. It pays for being precise.
Why most traders lose money and how to stop being most traders. Let's rip the band-aid off. Most retail traders lose money. Not because the market is unfair, not because of Wall Street manipulation, and definitely not because the algorithm hates you personally. Nope. They lose because they treat the stock market like a slot machine with candlesticks. Here's how it usually goes. They enter a trade with zero plan, no stop loss, and dreams of becoming a millionaire by Friday. When it goes against them, because of course it does, they hold, they hope, they average down. Eventually, they either rage quit or get margin called into a spiritual awakening. Want to not be that guy? Here's how. Step 1. Have a plan. I know. Revolutionary. Your entry, your target, and your exit before you get in. If you're thinking, I'll figure it out as I go, congratulations, you've already lost. Precision beats hope. Every single time. Step 2. Position sizing. If you're throwing 80% of your account into a single trade, you're not trading, you're donating. There's a reason pros only risk 1 to 2% per trade. They want to be alive for the next one. Step 3. Use a stop loss. And I mean a real stop loss. Not, I'll just watch it and get out manually. That's trader talk, for I'm emotionally attached and will ride this until my account burns. Step 4. Log your trades. Not just the wins, the painful ones, the dumb ones. The I don't even know why I bought this ones. If you're not journaling, you're not improving, you're just repeating. Step 5. Respect the process. One good week doesn't mean you're a genius. One bad trade doesn't mean you're a failure. This is a skill, one you sharpen daily. So if you're tired of being most traders,
Start acting like the 10% who treat this like a craft, not a casino. You don't need 100 trades a week. You need 5 high-quality setups and the discipline to execute them without ego. Because in trading, ego is expensive and humility pays.
How to build a watch list that actually makes you money. Let's talk about your watch list. The list of stocks you say you're tracking but haven't actually looked at since last earnings season. Be honest. Half of y'all are still watching AMC like it's 2021. Newsflash, the meme dream died. Let's build a real watch list, one that makes you money instead of nostalgia. Step 1, stop chasing everything. If your watch list has 100 stocks, that's not a watch list. That's emotional damage waiting to happen. Keep it lean, 10 to 15 names, max. These should be tickers you understand, not ones you saw on Reddit 5 minutes ago. Step 2, separate your plays. You need categories: long-term holds, swing trades, day trades, high volatility, dividend payers. Don't mix them like a Wall Street smoothie. Structure creates clarity. Clarity creates cash. Step 3, know the personality of the stock. Some names move like dancers, smooth, consistent. Others move like drunk uncles at a barbecue. Tesla is not KO. If you don't understand how a ticker moves, how can you possibly time your entries? Step 4, do your homework. You don't need a PhD in finance. Just know the basics. Upcoming earnings, major news catalysts, sector momentum, insider buying, institutional volume. Treat it like dating. Know something before you commit. Step 5, sync it with your setup. If your setup works best with trending momentum, stop watching consolidation stocks. If you love reversals, don't stock names that only go up. Align your watch list with your strategy, or prepare to lose strategically. Bonus tip? Use alerts. Technology exists for a reason. Set price alerts at your key levels. Don't stare at charts like a caffeinated owl. Final point. A good watch list doesn't predict the market. It prepares you for it. You're not supposed to trade everything on it. You're supposed to wait for the best setups on it. That's the difference between a sniper and a squirrel with a trading account.
Execution, where 90% of traders blow it. Everyone's a genius before the trade. You've got your trend lines, your MACD crosses, your Fibonacci retracements. You're practically the Da Vinci of trading. But when it's time to click the button, you choke. That breakout you waited all day for, you hesitated. That stop loss you swore you'd follow, you moved it. That position you promised to size small, you went full YOLO. Let's be honest. Your problem isn't your strategy. It's your execution. Execution is where most traders get wrecked. Not because they didn't know what to do, but because they didn't do what they knew. Discipline dies the moment emotions enter the room. You're not trading a chart anymore. You're trading fear, greed, hope, and please God let this reverse. So what's the fix? First, have a plan before you trade. Entry, exit, stop loss. Set it in stone. If you're improvising mid-trade, the market will punish you. Second, position sizing. If your palms sweat every time the candle twitches, you're oversized. Cut your size until you can breathe again. Third, journal everything. Yes, even the ugly trades, especially the ones you don't want to talk about. That's where growth lives. And lastly, stick to your stop like your trading career depends on it, because it does. Moving stops is how you go from red to broke. Bottom line, execution is discipline under pressure. That's the game. Master that. And the charts won't scare you anymore. Now let's take it one step further. Next up, trader psychology. Because if execution is the weapon, your mind is the trigger finger. Let's fix both.
Trader psychology. Your mind is your worst trading partner. Let's get one thing straight. Your brain was not built for trading. It was built for survival. So when the market drops 2%, your brain screams run. When the market rips 3% after you sold, it whispers, you idiot. Welcome to trader psychology, the battlefield between logic and your lizard brain. Fear of missing out? That's not just a buzzword. It's a biological reaction. You see green candles and think you're missing the next Tesla. So you chase, and guess what? The moment you enter, the chart nosedives like it saw your entry. Every time. Then there's loss aversion, your refusal to take a loss like a grown adult. Instead, you hold, and next thing you know, your small red is now a long-term investment you never wanted. Congrats, you just donated to Wall Street's charity fund. So how do you stop trading like an emotionally unstable raccoon? Step 1. Detach your identity from your trades. You are not your P&L. A red trade doesn't make you dumb. A green one doesn't make you Warren Buffett. Step 2. Pre-plan your decisions. You can't make rational choices when your heart rate hits 140 BPM. That's why fighter pilots train. You should too. Step 3. Master patience. The best traders are snipers, not machine gunners. If you're taking 5 trades before 10 AM, you're not disciplined, you're gambling with a keyboard. Final step, reset after every trade. Don't bring baggage into the next setup. Every chart is a new mission. Leave the drama at the door. We'll go deeper on how to build that sniper mentality next. Because if your emotions control the mouse, your account won't last long. Let's talk about patience, precision, and playing the long game.
Discipline, the most profitable skill you'll never flex on Instagram. You can post your Lando dreams and winning trades all day, but discipline, that's the quiet killer move that actually builds accounts. It's not sexy. You can't screenshot it, but without it, you're just a candle-chasing clown in a sea of smarter sharks. Discipline means not trading when there's no setup. I know, crazy, right? Sitting on your hands instead of forcing a trade? That's called professional behavior. Most traders blow up not because they don't know how to win, but because they don't know how to wait. You set your plan, you write down your risk, you map your target, and then the moment price starts dancing, you forget all of it like a bad Tinder date. Why? Because your ego hijacked your strategy. Discipline kills that ego. Want to size up your account? Start with sizing down your trades. Stick to your rules. No revenge trades, no emotional entries, and definitely no YOLO calls at 3:59 p.m. You're not Batman, you're a trader. Act like it. And when you're wrong, take the hit, move on, review it later. Don't stew, don't spiral, and don't go scrolling Reddit for confirmation bias. Here's the truth. Most traders know what to do. They just don't do it consistently. Discipline bridges that gap between knowledge and execution. Every successful trader you admire, they're just better at saying no to the dumb stuff. Up next, we'll break down how to build that discipline into your daily routine, because discipline isn't something you wish for, it's something you train. Let's go.
More trades, more profits? Yeah, tell that to your broker. Let me guess, you thought if you just took 1 more trade, you'd recover the last one. Maybe 2 more, or 5. Before you know it, your account is crying, your confidence is dead, and your broker's yacht just got a hot tub upgrade, courtesy of your strategy. Let's be real, overtrading is the financial equivalent of drunk texting your ex. You think it's going to feel good, but it's never ended well in human history. The market doesn't reward hustle. It rewards precision. You don't need 20 trades a day. You need one high-quality setup that you've backtested, recognized, and executed with 0 emotion. You need patience. But most traders are out here trading boredom, not opportunity. Revenge trading? Even worse. You're angry. Your brain's fogged up, and now you're clicking buttons like it's a video game. Spoiler, this isn't Call of Duty. This is your real money. And the market doesn't care how unfair that last loss felt. So what's the solution? Predefined trade limits. 1 or 2 trades a day. 3 max. Anything more than that and you're just feeding your dopamine addiction, not your bank account. Next up, we're going to talk about how people blow accounts, not because they don't know enough, but because they refuse to respect risk. Stay tuned.
System or circus? Why most traders fail at sticking to a plan. You ever notice how most traders talk about having a strategy until it stops working for 2 days? Then suddenly they're trying something new, adding 5 indicators, and watching a YouTube guru who trades on moon phases and gut feelings. That's not a strategy. That's a meltdown in disguise. Here's the brutal truth. Most traders don't fail because their system sucks. They fail because they can't stick to it. 1 red day and they're out. 1 green day and they're gods. That's not trading. That's emotional whiplash with a brokerage account.
A real system isn't built on vibes, it's built on rules. Entry rules, exit rules, risk rules, and most importantly, consistency. You need to know what your edge is and repeat it over and over like a psycho, because that's how consistency compounds. Discipline is the difference between a trader and a gambler in a hoodie. And yes, it gets boring. That's the point. If you want excitement, go skydive. If you want profits, follow your system like it's gospel. Next, we'll break down how to find your trading style, because no, you don't need to copy your favorite YouTuber or your cousin who kills it on Robinhood. You need a strategy that fits you. Let's build it.
Find your style or find your exit. Why you must trade like you. Let's cut through the noise. You can't trade like Warren Buffett and expect intraday profits. And you can't trade like a scalper if you cry when the candle moves against you for 5 seconds. The fastest way to blow up your account is to force yourself into a strategy that doesn't match your personality, time commitment, or risk tolerance. Some of y'all are trying to day trade with swing trader patience. Others are swing trading with the anxiety of a scalper. It's a disaster waiting to happen. So here's the deal. You need to figure out your trading style based on how you think and behave, not based on who you follow online. Are you analytical and patient? Swing trading or trend following might be your lane. Are you impulsive but sharp under pressure? Scalping could work, but only if you can stay disciplined and drink 3 less Red Bulls. Prefer to let time do the work? Long-term investing, options selling, or dividend strategies are your friend. The point is, you have to trade in a way that lets you sleep at night, not sweat through your sheets. Because when the market slaps you, and it will, you won't survive a strategy that was never built for you in the first place. In the next segment, we'll talk about risk management, the grown-up part of trading that actually keeps your account alive. Yeah, it's not sexy, but it's why the pros are still here and the gamblers are back working double shifts. Let's go.
The psychology of holding winners and why most traders can't. You nailed the entry. Perfect setup. Indicators lined up. Price moves in your favor. You're up $100, then $150, then a red candle shows up and boom, panic. You close the trade, pocket $80, and high-five yourself until you check back and see it hit your original target. You left $400 on the table because you couldn't sit still. This is the disease most traders have. They can't hold winners. Not because the setup is bad, but because emotions are in charge. The moment the trade is green, your brain treats it like a scratch-off ticket. Take it before it disappears. And that's the trap. We don't hold because we trust the chart. We hold because we trust our fear. The moment we feel gain, we react like it's a scam. No way this lasts. So we bail. Too soon. Every time. But the pros? They hold because they've already accepted the outcome. They know their edge. They have a plan. They scale out. They move stops. They let the rest ride. They don't flinch when a candle hiccups. You want to hold winners? Here's the fix. Pre-plan your trade. Target. Stop. No winging it. Profit. Reduce stress. Let the rest run. Your trades. See your own self-sabotage in writing. Detach from the P&L. You're not here for dopamine. You're here for discipline. In trading, sometimes the hardest move is no move at all. Learn to sit on your hands and watch your profits grow legs.
Why most traders lose before the market even opens. Let's be real. Half of you are losing money before the bell even rings. You're waking up, grabbing your phone, scanning Twitter for hot picks, and jumping into trades based on what some dude named StonkWizard420 said at 3 a.m. That's not trading. That's gambling with Wi-Fi. Now, here's what real traders do before the open. It's not sexy, but it works. They start with economic news, CPI data, Fed talk, jobless claims. You better know what's going to punch the market in the face today. Next, pre-market levels. Where's support? Resistance? Any gaps from overnight? That's your battlefield. If you don't know it, you're walking into a war zone blindfolded. Then they check volume leaders. Not because volume is hype, but because volume tells you where the money is going. Big players move big volume. You want to follow the elephants, not the squirrels. And finally, the watch list. A real one, not 20 tickers and vibes. I'm talking 2 or 3 setups max. High conviction, high probability. Entries, exits, stops. All locked in before you click the buy button. If you're reacting at 9:31 a.m., you're already behind. Pros don't chase, they prepare. So next time you think you're a trader, ask yourself, did I do my homework or am I just winging it again? Because if you treat this like a casino, the market will gladly be your dealer.
How to spot a bad trade before it destroys you. Let's be honest, most bad trades don't sneak up on you. They walk in the front door wearing red flags like it's fashion week, and still you let them in. First sign, you're rationalizing the trade. You're saying things like, well, it might bounce, or I'll just hold a little longer. Newsflash, if you're negotiating with your own stop loss, you're not trading. You're gambling with hope as your strategy. Second, no clear setup. If you can't name the pattern, define the risk, or identify a clean entry, you're just clicking buttons because you're bored. That's not trading. That's boredom with access to capital. Third, you're oversized. If your heart rate spikes with every tick, congratulations. You're emotionally invested in a trade you weren't technically prepared for. The market smells that fear, and it eats it for breakfast. A good trade respects your system. A bad trade hijacks your emotions. And the sooner you learn the difference, the longer your account survives. ...
Execution is the final boss. Let's cut the fluff. Execution is where 90% of traders lose, not on analysis, not on research, but on clicking the damn button. You can study charts like you're prepping for a PhD dissertation, but if you hesitate when it's go time, you're toast. Execution is not just buy low, sell high. It's about knowing exactly when to enter, how much to size in, and when to cut the rope before you drown. Sounds simple, but when real money's on the line, your brain turns into mashed potatoes and suddenly that perfect setup looks iffy. Here's the truth. The market doesn't care how confident you are, only how consistent you are. Got a strategy? Good. Now follow it. No freelancing, no vibes-based entries. You wait for confirmation, you hit the order, and you move on. Most of you lose because you either entered too early because of FOMO or too late because you were still watching a YouTube video on how to confirm a breakout. Meanwhile, the breakout already happened, and guess what? You missed it. Again, discipline and execution is what separates traders who grow accounts from those who blow them up every other month and start blaming the algos. It's not the algos, my friend. It's you. Up next, exits. Because everyone's a genius when entering, but exiting? That's where the money's made or lost.
Exit like a killer, not a poet. Let's talk exits. And no, not the poetic kind where you ride it out and hope for the best. Exiting a trade is a skill, not a speech. And most of you get in fine, then hold like it's your grandma's retirement fund. Why? Because emotions run your trading, not your plan. You know how many profits get erased because someone wanted just a little more? Newsflash, greed has no loyalty. The market gives, the market takes. Your job? Take first. You need a rule. If it hits your target, get out. If it hits your stop, get out. If it's moving sideways longer than your dating life, get out. Great traders don't guess. They plan the exit before the entry. Most of you don't even think about the exit until your gains start turning red. At that point, it's no longer trading. It's coping. Want to be consistent? Your exit strategy needs to be boring, predictable, ruthless. You're not here to be artistic. You're here to be profitable. You don't hold because you believe in the company. That's investing. This is war. You execute your mission, extract your profit, and disappear like a ghost. Because at the end of the day, execution isn't about knowing what to do. It's about doing it every time, on time, without flinching.
This is where traders are made or broken. You made it, the full hour. Through indicators, strategy, psychology, risk, execution, and all the sarcastic truth bombs I could throw at you. And if you're still here, congrats. You're not just a curious newbie, you're someone who's actually trying to level up. And in this game, that alone separates you from 90% of traders who never take it seriously. Like, let's recap one last time, but real talk style. You now know that indicators don't predict, they react. That price is king, but indicators are the scouts. That execution trumps excitement, and discipline outlasts hype. And that most people lose money not because they're stupid, but because they're emotional, inconsistent, and allergic to strategy. Like, let me say this again louder for the people in the back. No, emotion is expensive, discipline is profitable. Now ask yourself, honestly, are you going to be the person who takes this and builds a system? Or are you going to go back to throwing darts at TikTok stocks and buying options because some dude on Reddit said, this is the next Tesla, because this is the fork in the road? You've been armed with the tools. You've seen how pros think. You've learned the mindset, the charts, the rules, and most importantly, you've been warned. From here on out, your results are on you. You don't need more indicators. You don't need more hype. You need more reps, more discipline, more execution. That's what makes a zero emotion trader. So here's the move. Pick a strategy. Define your risk, trade it 100 times, track it like your life depends on it. Because in a way, it does. Your freedom, your income, your control over your life. That's what this skill gives you, and that's worth more than any one trade. I'll leave you with this. Traders aren't born. They're built. One trade, one lesson, one loss, and one comeback at a time. You just took the first step. Now go finish what you started. You know the brand. You know the mindset.
How to be profitable in the stock market. Welcome to the stock market, the place where hopes go to die, wallets get humbled, and beginners confuse luck with skill. Until they don't. If you're here for magic indicators or TikTok tips that turn $100 into a Lambo, you're in the wrong video. But if you're here to actually learn how to be consistently profitable, stick around. This might save your account. Now listen, profitability isn't about finding some mythical stock whisperer who lives on Discord and has a 99% win rate. It's about mastering discipline, strategy, and self-control. You know, the exact opposite of what most people bring into the market. This video is your no BS roadmap to making money in the market without losing your mind or your mortgage. We're going to talk about capital preservation, risk management, trading psychology, and why your gut feeling is probably indigestion, not a trade setup. You'll learn the difference between being a trader and just gambling with a brokerage account. So grab your notebook or your therapist, because we're about to break down what it really takes to be profitable long-term. And yeah, I'll make you laugh, but you'll also leave smarter, which is more than I can say for 90% of FinTalk. Coming up next, we're going to dismantle the fairy tale that profit comes before risk. Spoiler alert, it doesn't.
The lie they sell you, profit comes first. Let's get this straight. Profit is not the starting point. It's the byproduct of doing everything else right. But Wall Street influencers and brokerage ads, they sell you the dream first. Make $500 a day trading from your phone. Oh, really? Then why are you still renting? The truth is, risk management is the foundation. You want to be profitable? First, learn how to not blow up your account. Before you think about how much you can make, you need to know exactly how much you're willing to lose. Most people skip this part. Then they cry on Reddit and blame the market like it stole their lunch money. A real trader focuses on position sizing, stop losses, and win-loss ratios. You know what professionals obsess over? Risk-adjusted returns. Meanwhile, amateurs are out here throwing their whole account at meme stocks because someone on YouTube said, "Trust me, bro." You'll become profitable the day you stop chasing gains and start protecting your capital like it's your last dollar. Because in this game, it might be. Up next, we're diving into why trading without a plan is like skydiving without a parachute. And no, a gut feeling doesn't count as a plan. Ready? Say next. Your gut feeling is not a trading strategy. So you felt like Tesla was going to bounce? Adorable. That's how gamblers talk before they lose their rent money in Vegas. Listen, your gut might help you decide between chicken and steak, but it has zero business managing thousands of dollars in the market. A real strategy is tested, defined, and repeated. That means you know when to enter, why you're entering, and what signals confirm the setup. If you're just buying because you have a feeling, congratulations, you're trading on vibes, not data. And vibes are not profitable. Every successful trader has a written plan. Entries, exits, stop losses, setups, even emotional checkpoints. You don't just wing it because the chart looks spicy. This isn't Tinder. This is money.
Now here's the kicker. Even the best plans lose. But if your system has a positive edge over time, you will win. Period. No crystal ball required. The more you rely on feelings, the more your account turns into a therapy session. Coming up next, let's talk about how people lose consistently by overtrading, revenge trading, and thinking more trades equals more money. Spoiler alert, it doesn't.